Hello, everyone. Welcome. We'll give a moment here for technology to catch up with us as everyone joins our webinar. You are joining REDW Wealth's webinar on rethinking your retirement strategies for 2024. This is a follow-up to our giant Secure Act 2.0 download that happened a few months before. That one was a bit heavy. This one is lighter, we promise. Talking now, you have our firm's senior financial planner, myself, Christine, and then I've got our wealth principal, Rob Elsholz, joining us. The two of us will walk you through the individual side, and then a couple of days later, we've got the business side of things. So if you're really keyed up for that one, you have to wait a couple of days. Diving in, because we're all sitting here with our time and wanting to make sure that it's valuable, let's talk about the basics. What we will run through. What's changed with contributions? What's changed with distributions? And then what are the strategies? What should we be doing in light of all of these things that are happening next year or have already happened in the previous few iterations of the Secure 2.0? Let's walk through those now. On the contribution side, one pretty neat thing that happens in 2024 is this emergency savings account. Think of it as a little sleeve being carved out of your 401k plan that you can access for emergency savings. This is really targeted towards people that don't have the ability to build up that discretionary savings account. So it is geared toward these non-highly compensated employees, so people that might not be able to choose between, well, you'd have to choose between, do I save or do I save for retirement? So now you can get that competing goal away and make it to where we are actually seeing people be able to do both in one. So that's a great little change. There's some nuances, right? You've got limitations on how much you can put in. You've got limitations on how much you can take out. So it's there, but it's there as a tool. Then we've got another fun one, especially now that most of you who have student loans are now having to pay them back. Nice little timing on this, that now that you've got to start paying them back, you can do so, but your company can decide, oh, well, this is something I can actually reward you for and use as a match. This is going to be a great tool for employers to keep talent that are in that space that are really paying back those student loans. It's also a benefit for those people in the payback window. So this is a good thing to look for employers that are really implementing these. When we move forward, we've got something that was supposed to happen this year, which was this age-based catch-up contribution. This one is one a lot of people have been waiting for, because this provision says that if you are over a certain level of income, if you make a certain amount, your catch-up contributions, people that are age 50 and over get these catch-up contributions. If you're in that window, those catch-up dollars have to be Roth or after-tax dollars, which isn't ideal because typically somebody in that window who's making that much wants to defer as much income as possible. IRS wants their revenue. They're saying that this catch-up contribution now has to be Roth dollars. However, because plans were not set up for this, some plans didn't even have the Roth 401k or Roth options, Roth contribution options. We'll give you a 2-year window for administration purposes. So that is not happening until January 1st, 2026. So we've got a little push out to that. The other piece that will happen, not in 2024, this is a little precursor, we're giving you a teaser for 2025. This is where there's another threshold, an additional catch-up contribution for those people that are a little bit closer to the transition period for retirement. That 60 to 63 age group window, you're getting a little bit of a bump up on the ability to do an additional catch-up. The other thing that's really neat that we didn't have before is these catch-up contributions are now going to be indexed for inflation instead of just sitting at the $1,000 threshold. Now you're actually going to see them keep up like the rest of the limits do, or at least I shouldn't say they keep up with inflation, but they increase So they will be indexed to inflation.
And it's worth noting.
Yeah.
Oh, I'm sorry there, Christine.
Oh, go
It's worth
ahead. I'll go
noting,
back.
just going back one slide there,
Yeah.
is that that's in addition to
Yeah,
if
on
you're already
top.
doing the catch up if you're 50, if you're over 50. So this is an additional sweetener that's there. And it's something that we've experienced and had a lot of questions on over the years from the folks that once they hit 60, they go, well, wait a minute, when I hit 50, I got an opportunity to save more. I don't get something for when I'm 60. Well, now you do. So this is
Extra
really
bonus.
good noting. It's a bonus. It's really good noting here that it is an addition to that amount.
There is something good about turning 60.
Yeah, absolutely.
When we go over to the next slide, we just had, so all of the numbers that you hear, oh, the limits for this or that throughout 2023, those were all projections all the way up until last week. Last week, the IRS gave their official, here's the numbers, this is the limit for 2024. They always issue them in October. So if you hear somebody project something for the following year before that, take it with a grain of salt. In October, this time towards the very, very end of October, we got the numbers. And here you'll see we get those boosts in a few of these contributions. The health savings accounts go up. I am not going to read these word for word because we are giving you this deck. If you are part of this, if you even just registered and you're not part of this, or you're watching this on demand, you have access to the deck. If you don't have access to the deck, you can email us. We have a contact at the end. So please let us know. A couple of things to note. We don't know the federal estate and gift tax exemption just yet. That increase is not official yet. So anything you see out there is still speculation. Same with that annual gift exclusion.
And it really is. There's some interesting things that really come with this number. There were some jokes last week when it got announced of, well, did you miss it? Because most people did when they even announced it with it. The 401k contribution going up $500, and there's nothing additional for the catch up. However, there are some unique things here with pension plans, and I'm going to talk a little bit more about that in Thursday's webinar for our plan sponsors. So more to come on that.
Yes. The nice part is that Social Security COLA came in just a little above 3% at 3.2. We really thought it was going to be 3% most of last year. So seeing 3.2 is a nice little boost.
Yep.
All right. Now on the distribution side. So what should we expect for 2024 on the distribution end of things? Big change that really came into effect this year was that required minimum distribution getting pushed out. So now you have that 73 being the big chunk, the big cliff for the next 10-year window. And then in 2033, it jumps up to the full 75. So you've got the slight push out of when you have to take these required distributions. One thing that they did a little bit favorably for people that forget, you no longer have to owe half of that portion that you forgot. Now it's only 25%. And if you recognize, oh goodness, I made a mistake, and you correct it in a timely manner, we'll just take 10%. So that's a little bit of a forgiving piece, which you don't know is good until you end up forgetting or something happens. Oftentimes, this is where we tie into make sure you have a power of attorney. A lot of times, the reason these required distributions get missed is because people take at the end of the year, and for some reason, some medical reason typically, they're not able to take that action. And if you have a power of attorney, that person can step in. The Roth required minimum distributions is now eliminated in terms of you used to have to take from a Roth 401k a required distribution. Now you no longer have to do that. When it's an inherited Roth IRA, different story. And we'll talk about the inherited piece soon here, because that is a very big topic that's coming, because it has changed since 2019. And some of those changes are still shaking out. When we look at this last piece, the qualified charitable distributions, this is one that they graciously did not change the age on. So you can still do this after age 70 and a half, which is good because maybe you're deciding that you want to give to charity and this ends up being the most impactful way. We encourage you to have a more specific charitable strategy that identifies goals, recognizes what might be that tax high impact asset for you to give, and then the timing around it. However, what is new and unique is this one-time $50,000 charitable distribution to an avenue that you now have a little bit more control around. And that's a trust that's created for a charity that eventually either goes to the charity or to your family. So you have a little bit of leeway around this. These charitable remainder unit trusts, these charitable remainder annuity trusts, all of these leave a piece to the charity, but they give income to another beneficiary throughout the lifetime. So this is something to really look at, especially now that interest rates are a little higher. And I say that because the beneficiary might get a larger portion, because the way that those income pieces are calculated are based off of interest rates and what that underlying investment can get. So from an actuarial perspective and life expectancy even, this is a good time to explore that avenue, not just for anyone, anybody that's charitably inclined or philanthropic, but everyone all together to really look at that, because it is giving that income to a beneficiary in the meantime. We will also explore this lovely piece that is huge for people that are saving and get scholarships, or they're saving and multiple family members are saving for college through these 529 plans. This was a long time coming. We are pretty happy about this one. If you come into it to where you've saved money into this 529 plan, you've done so for 15 years, and either the person goes to a trade school that doesn't cost as much, or they got scholarships, or for some reason they just chose to go straight into the workforce, they're not needing this 529 plan for whatever reason. This 529 plan has dollars left over that are not going to other beneficiaries in the family. What do you do with it? Instead of having to take it out and pay the penalty and ordinary income tax on it, the IRS is recognizing, okay, we need to give people a little bit of an avenue for this to be transitioned into a savings vehicle for retirement. So now they are letting you roll over a lifetime amount of $35,000 from a 529 plan to a Roth IRA. However, you have to do it in the amount of the contribution for that year. So you can't move all $35,000 at once. You have to do it in increments. And then you also have to have earned income, or the beneficiary has to have earned income. One thing that wasn't addressed, which is when you start thinking about this and playing the game, you think, well, why don't I do this? Change the beneficiary, do it again, change the beneficiary, do it again. They haven't addressed that piece yet. Pretty sure they'll shut that down. And I bet there's a private letter ruling about it already.
Yeah. This really creates a great planning opportunity for folks who, one, want to make sure that their beneficiary of the 529 plan can really start off on a great foot for the retirement plan. And there is the loophole currently, which it's probably going to get closed, but it isn't currently closed. And you're able to really, really, really take advantage of this opportunity. And that no income limit also is a tremendous opportunity for someone to start off on the right foot as they enter the working world from college. So this is a tremendous planning opportunity.
Yes, so many things that a Roth IRA can do for you.
Yes.
Okay. Now this next part is distributions. It's not part of 2024, but it's very much a big part of questions we get asked, strategies that get talked about. This is what happens when you inherit these Roth IRAs, or not Roth IRAs, but IRAs altogether. When we're looking at anything after 2019, that's when the big question comes up. Typically, most people are fairly familiar with what happens if somebody passes away before 2019. But if you have somebody that has passed away after that, now we have these new rules that this first Secure Act put into place. And then there has been IRS clarification after IRS clarification, because not only were the rules written to where some of them actually had clerical errors and mistakes in them and needed corrections, but they just weren't as clear. we have this chart from our original article on it. I'll talk through a little bit of this, but there's also a little caveat on a couple of things. So bear with me as we walk through it. If you inherit an IRA and you are an eligible designated beneficiary, you get to move this into your own IRA. You have the stretch distributions, which was a huge benefit from before. That stretch IRA option went away for people that were more than 10 years younger and non-spouses. That's this middle bucket now. So typically, the person who's inheriting these IRAs might be a child or that generation that is more than 10 years younger. That is the bucket where we now have some questions around the original owner. This non-eligible designated beneficiary, which typically ends up being the second generation of the child that receives this. The question then becomes, did this person die before their required begin date, before they had to take distributions from their IRA for that required minimum distribution, or after? If the answer is that the original owner died after the required begin date, there's a clarification. You now have to take normal annual required minimum distributions at the very least. And you have to take everything out within 10 years. The understanding originally when the Secure Act first came out, the very first one, not 2.0, regular Secure Act, when it came out, the thought was that you could take it at any point in any increment over that 10-year window. As long as it was out by 10 years, then great. So a lot of people were kind of waiting or timing it or taking some amount one year and then none the next, which you can do to some extent still. But if the original owner has passed away past the required begin date, you have to take that minimum amount on your life expectancy. The trusts and non-designated beneficiaries are now limited to a 5-year rule. That's similar to before, very restrictive on those. So typically, if you have a trust that's inheriting it, you want it to have pass-through language so that it is really going to those final beneficiaries in their own IRAs. What is different and unique is that Roth inherited IRAs. There is still some discrepancy around this. A lot of the major banks and even some of the big, players within the financial industry altogether say that a Roth IRA never has a required begin date. So even if somebody passes away after the required begin date, it doesn't matter. For an inherited Roth IRA, you really still have the flexibility in that 10-year window, and that's it. However, there has been some people that interpret it as you would still have to take it. So we're waiting for some clarification on the IRS to tell us in a new notice about the inherited Roth IRAs. The nice part is, doesn't matter at all for 2023 because they've given us another extension to where you really don't have to take that annual stretch distribution or that required minimum amount until 2024. So it will be an issue next year. That's why we've put that in here. And one thing Rob actually brought up that we've come across is a unique situation regarding thrift saving plans. Thrift saving plans, if you work for the government or the military, those federal plans have a unique thing when it comes to inherited features. If you're a spouse, great, doesn't matter. You can move it into an inherited IRA. You could sometimes make that TSP your own. However, it's that next layer. That third person that inherits it is not allowed to have a thrift savings plan, but you also have to take it out as a single lump sum. You cannot stretch it for 10 years. You cannot roll it into an inherited IRA and have the flexibility. You're now stuck with what's called the TSP tax trap.
Yeah, this is something where a lot of folks don't leave the TSP program because it's perceived as free. There is a trap behind it here. And most people are like, oh, well, the next generation, what am I going to worry about with it when it goes to that? But the next generation tends to be the kids. So mom, let's say mom worked for the government. Dad gets it, dad passes away. Now this has to go to the kids and you're distributed in the same, you have to take that as a distribution. It's a mandatory 20% withholding to the IRS. And if this is a large balance and it's going over a few families or one family, this could have a major impact across how all things are done with inside of your tax plan. So it's something to really plan for ahead of time and talk to the generation who has the TSP, or if you have the TSP yourself. And then around this here with the beneficiaries, making sure you designate your beneficiaries correctly is very important. Where we see some mistakes sometimes is it's going to go to the estate of, and that 5-year rule can really come into effect when you have to take those funds out, if depending on when somebody passed away. We are going to be experiencing the largest generational transfer of wealth in human history here over the next 30 plus years. And making sure your beneficiary elections are correct on retirement plans is very important. I cannot understand how important it is. And making sure that you have everything titled correctly, so you don't have to necessarily fall into a tax trap, is something to plan on the front end.
If you're watching this on demand, pause it right now and go check your beneficiary.
Yeah, exactly. If you're watching it on demand.
That's the first strategy for everyone. So we'll dive into the strategy part here. Strategies, they're very unique. So when we talk about these are high level, they're not blanket. It's very much, if you want to know about your specific situation, come talk to us. We'll walk you through it. Some things that have come up with these 2024 changes, and some of these are things that have always been around, but some things that have come up. If you're a younger individual, there is no real reason to not contribute to that match. I know sometimes it seems like that discretionary income bucket gets smaller and smaller and your net pay is just, it's not much, but always try to at least get to your company's match. And some of them are really competitive. We're seeing companies even show 6% matches, 4%, 3%, pretty standard. But when they're competing to get talent, that piece is something a lot of people, you look at that salary number annual and you just kind of focus in on that, when really these side benefits can add up quite a bit. So as you're into the early parts of your career, always try to contribute that match. Take advantage of this new student loan match option. A lot of people I've talked to recently are getting caught up in these IBR, pay as you earn, the new save, all of these strategies that hopefully have some forgiveness level at the end of them. When you run the numbers and the calculations, the total amount that you're paying is so much higher, even with that forgiveness piece. And that forgiveness piece is all ordinary income taxable to you. So you've got this big lump sum in some window time frame. So even if it's a 25-year time frame, the total dollar amount that you're paying can really be benefit by this piece where, okay, let's just pay some of it now, get the total dollar amount lower, even with the forgiveness amounts that may or may not happen or happening for you, depending on what your plan is. And then look at, well, this match is going to build up some of my savings. So you've got some benefit on the other end of it. Consider backdoor Roth contributions. If you are in that bucket, this is a huge thing. I don't see as many people doing this or taking advantage. At the very least, if you contribute and it's not deductible, track it. You paid taxes on that money. Don't hit yourself on the other end of it where you're paying taxes on it again just because you didn't keep track of the fact that you put in after-tax dollars into a traditional IRA. So think about that at the very least. This backdoor Roth contributions, the reason that we don't see people doing it that much is also because of the organization, right? And you have some small amount in a traditional IRA. So instead of contributing to the traditional IRA and then converting it over to a Roth IRA, you say, nah, I'm not going to do it because I have to do it proportionately in the amount that I already have in my traditional IRA. I have a solution for you. If your traditional IRA is mediocre or even small, consider actually rolling that back in to your 401k of your company. And then you have a clean slate. You don't have any in a traditional IRA. So you don't have to worry about that hurdle in your mind of having to do the math, which If you need somebody to do it, just call us. We'll help you. But at least if you did have some, maybe you only had a small 5 or 6,000 in a traditional IRA. Think about rolling that back up into your 401k, which seems counterintuitive. Most people are telling you to do the opposite. But if you're doing a backdoor Roth, well, now it's all of a sudden cleaner to do. Another reason that rolling it back in might be a good idea is if you plan on retiring early and you're over 55 and you separate from employment, you don't have that 10% penalty between age 55 and age 59 and a half. If you separate from employment and you have all this money in tax deferred dollars and you're taking it out, well, you can avoid that 10% penalty. So that's another strategy for people that makes sense for. Then we've got the Roth conversion timing. This is one that we get asked all the time. Rob and I are having this conversation day in and day out. It's, well, what's a solution? And you really want to spread your tax burden as thin as possible. If that means that you're paying a higher tax now, well, tax deferred starts to make more sense. But then there's an issue of longevity. How long are you going to live? What can you grow that Roth IRA at? And one of the things that we do with clients, and that's part of our process, is tax mapping and finding out what's the best strategy. And I'll give you a couple of examples here. This is an example of a tax map where we can start to see, well, can we convert a few more dollars? Can we move 1,000 or 2,000 a year over? Even if we're doing minuscule amounts, what's the long-term impact? And we start to look at a tax map like this to see what's the percentage on the dollar that we would pay depending on how much we're converting at this point in time. And it might make sense to do it in a window when you've left employment before you're on Medicare, to do a little bit of converting. A lot of times it makes sense to just do a little bit now, because that's when you have the most time to let it grow. Even though the tax percentage on the dollar is a little higher, maybe taxes in the future are still going to be high. So if you're paying high taxes now and you're paying high taxes later, it might make sense. One of the things I want to highlight is just the complexity around Roth conversions. I think people try to oversimplify this, and they'll come in and they'll tell you, well, if your taxes are low now, put it in the Roth. If your taxes are high now, put it in tax. If you think your taxes are going to be lower, it's not just this pendulum that you have to look at. One of the things that you want to think about is all of the income that you're expecting in the future. And it could even be just for your beneficiaries, right? If we're trying to look at taxes paid overall total across not just your life expectancy, but a spouse's. Okay. And then also maybe even some errors beyond that. If you can take that tax burden and make it thin and small early on, great. But maybe it's not for everyone either. Maybe the tax deferred makes sense and you're in a really high tax bracket now, and your income on the other end really isn't going to be that significant. And maybe your longevity is, the break even's around 84, and you typically in your family, people only live about that long. And you don't want to really think about, well, I don't want to pay higher taxes just to pay higher taxes to get it down. So there's a lot of thought process that goes around it. And I'll just skip forward a couple more times here because surprisingly, I'm actually on time, but I'm always overwinded on these things. I'll give you another little glimpse of some of our tax planning strategies that we do with clients, just to give you a view of what that result might look like. We're looking at the actual dollar amount in total tax dollars and then also portfolio value to see what is the quantitative side of doing those Roth conversions. And I'll leave it here on our contact page as we continue to open up for more questions. I know actually a couple have come through and we've answered them on the chat, so feel free to put more in there. Or if you want to follow up later, you have our emails, our contacts here. We're open to have any 15-minute conversation, even if you just want to have a brief little specific strategy question, or feel free to pass this on if you feel there's someone that you know that might benefit from this conversation.
Yeah, I will say that it's where we get a lot of the questions. They come in is when we retire, or someone's working with an advisor on the time that they're saving, which they should be. They're really good about the saving part. Where it really matters is working with professionals. when it comes to taking the money out. And where we get these questions when folks retire is go, you know what, where's my next 10,000 going to come from? And that's where we can help out answering with those tax mapping questions. So our contact information is here on the screen. I know we're against time. Thursday, we're going to dive a little bit deeper into some of those areas that we started off with for businesses and the plan sponsors of those businesses. So there's no other questions. We appreciate it. Our contact information is here. Please reach out to us, and you all have a great day.
Thanks, everyone.